This conference will now be recorded.
Thank you for joining me today for WIDA's First Time Homebuyer webinar. We will cover a lot of information that will hopefully be beneficial in your road to homeownership. So grab a chair and a pen and paper and let's get started. Please visit our website at www.wida.com to view full program details. The information contained in this training may not highlight all requirements of these programs and does not reduce or eliminate any requirements set forth in our guidelines. Guidelines are subject to change without notice. So let's get to know WIDA. What is WIDA? WIDA stands for Wisconsin Housing and Economic Development Authority. We are the State Housing Finance Authority. We're mission driven and we're a state authority that provides affordable home financing and helps residents become homeowners. We do have income and purchase price limits based on our programs, county, and household size. We work with over 130 approved lending partners, so you can work with someone local. But your loan will be serviced by WIDA in the end. We tailor a lot of our loan programs for your needs to make owning a home more affordable. Every year we compile the data of a typical borrower characteristic of WIDA and also our loan characteristics. And as you can see, the average loan amount for a WIDA loan is slightly below the national Wisconsin average, but over half of WIDA borrowers put little to no money down into the transaction. And almost over 3/4 use our down payment assistance options. Typical borrower characteristics, as you can see, we are primarily first-time homebuyer driven because we have a great program specifically for first-time homebuyers with a reduced rate, which we'll talk about briefly later. Most of them are under the age of 41 and have a household size of 1 to 2. But you do not have to be a first-time homebuyer to be eligible for a WIDA loan. As you get into this process, you will hear a lot of lingo in the industry, and as you get farther down the road and meet with a loan officer, you will start to hear some mortgage terms. It's important to understand what these terms mean because they will affect your loan situation and the questions that you may want to ask. First is loan to value. This is the percentage of mortgage in relation to your home value. So for example, if there's a value of the property of 100,000 and the mortgage is for 97,000, that is 97% loan to value. The next would be an appraisal. This is a written estimate of a property's current market value based on the home's features and comparable property sales within your area. So this is ordered within the process of the purchase to verify that what you're paying for the property, it's worth what you're paying for. Down payment, that is the amount of home purchase paid up front. So money you would put down towards the transaction that you would not be financing. Debt to income. Your debt to income ratio plays a big role in your loan. This is the percentage of your monthly income that your current debts and your current mortgage payment will take up. So they want to make sure that your debt to income is in a comfortable level for you so that you are not making payments beyond your means and you have money left over each month for other expenses. Mortgage insurance. Mortgage insurance is an insurance policy which compensates lenders or investors for losses due to the default of a mortgage loan. Mortgage insurance is required on any loan that where you don't put 20% down. If it's over 80% loan to value, mortgage insurance will be required on the loan. And the cost of that is based on your total loan to value, on your first mortgage. But it is pretty standard and it unfortunately doesn't benefit you much, but it is required because the less money put down, the higher the loan to value, the more risk it is for the bank or investor, and they just want to have that insurance policy if you default. Amortization. Amortization means paying off a loan with regular payments over time so that the amount you owe decreases with each payment. WIDA first mortgage loans amortize over 30 years, which is the standard mortgage loan term. There are also 20-year mortgages and 15-year mortgages and 10-year mortgages. Typically, a first mortgage is 30-year fixed, and that's what all loan programs are with WIDA. Annual percentage rate. It's very important to know when you're looking at your interest rate versus your annual percentage rate that those will be different. Your interest rate is what you're paying, the amount of interest you're paying on that loan each month in your payment. The annual percentage rate is something that is disclosed to you throughout the loan process to show you what the overall cost of your loan will be. So your interest rate plus any fees associated with the mortgage over the life of the loan gives you your APR. If you're out and you shop around through different lenders, you may see different APRs, and that will tell you if you're paying more fees from one organization to the other. Escrow. An escrow account is set up by your mortgage lender to pay certain property-related expenses like property taxes and homeowners insurance. A portion of your monthly payment goes into this account. WHEDA does require that you escrow for property taxes and your homeowners insurance and mortgage insurance each month. So your payment is made up within that of those equal installments over 12 months, split into 12 payments, so that at the end of the year, your property taxes will be paid. And when your homeowners insurance policy comes due, that money is there to pay as well. That way you do not have to come up with that amount in bulk at one time each year. Let's talk about the benefits of owning versus renting. Predictable monthly payments and owning can be cheaper. As you know, a lot of rental costs right now is pretty high, and interest rates are pretty low. So sometimes what you will see is that owning a home can be much cheaper than paying rent. And as a homeowner, you'll have a predictable mortgage payment for 30 years. And in Wisconsin especially, and you'll see some examples of this, many times it can be less expensive to own. Your house will increase in value over time. Owning a home provides you with a valuable asset that in many cases will rise in value over time, providing you with a great investment for retirement, a rainy day fund, and it also builds generational wealth. The appreciation as you pay your loan down and your home grows value over time, that's called equity, and that equity can be used for many things. Some people take out a home equity line of credit to do some home improvements. Sometimes people refinance their loan and take cash out of that equity to pay for certain things. But otherwise, that is, if you go to sell your property at some point and buy another home, that equity can be used for the down payment on your next home. You're free to make the modifications you want. You can make that house your own. Paint it whatever colors you want, add on another addition or room. That is your choice. It is your home. And obviously, as a renter, you can't alter the space that you're renting without permission from the landlord. Community ties. Owning a home allows you to have an impact on your community. The taxes you pay benefit local schools, businesses, and organizations. The next 3 slides are going to show you examples in 3 different areas of Wisconsin of a home and a rental unit similar in size and square footage and bedroom type or bedroom number. That shows you what it costs for that monthly rent versus what it costs with a mortgage for purchasing a property similar to that. And as you can see in all 3, what you will see is that owning a home in these 3 situations is less than paying rent for basically the same amount of space. So here's an example in Milwaukee. The next is an example in Madison, and this does include mortgage insurance, as you can see in the bottom left-hand corner. And then finally, Green Bay. Green Bay, obviously, that's a huge difference. You know, almost $400 or $500 a month cheaper to own a home, and it's yours, and you're building that investment. So sometimes people are just nervous about becoming a homeowner. They don't really understand the whole process, and that's why you're here today. And I'm hoping that you'll get a lot of great information that you can use going forward so that you don't feel nervous about it and that you have the knowledge that you need to be a great buyer and an educated buyer to make the best decisions for your situation. Some people do have credit concerns. Your mortgage loan officer will let you know what you qualify for. You can request a free copy of your credit report once a year from annualcreditreport.com. It doesn't usually give you your score unless you pay. I think you have to pay for it to get your score, but it's good to always know what is being shown on your credit report in case there's something that shows up that's not right. You have to dispute something, something that got added on that you weren't aware of, a medical collection or something like that. It's always important to know what your credit looks like, and that doesn't hurt your credit doesn't impact your credit if you just do it once a year through annualcreditreport.com. Obviously, when you get into this process, the lender will pull your credit and go over everything with you. But going forward, and just if you want to know now, that's another option for you. Lack of knowledge. Some people are a little bit nervous because they're not really sure how this whole process works. We're going to learn a lot about that process today, and hopefully I can help you answer some questions, and also I'll give you some helpful resources. Picking the wrong house. We're going to talk a little later about the difference between needs and wants and how that plays a big role into finding the correct house for you, and which leads me into the next thing about affordability. When you get pre-approved, and we'll talk about this in more detail, you will know exactly what you can afford in a way that is comfortable for you and that the bank is okay with, that debt to income ratio we're going back to. And you never thought you could own a home. But the truth is, anyone can own a home. Even if you have to start somewhere or you're a little farther down the line, we can show you how today. We're going to walk through the steps of home ownership. These 6 steps to home ownership are also on our consumer pages. So you can click on these and get more information under each step and resources. Step 1, managing your money. Creating a budget. What is a budget? Basically, it's diving deep into what you spend your money on each month. A good way to do that is to pull a bank statement for 30 full days and look through and find out exactly what you're spending money on. Sometimes we don't realize that eating out here and eating out there, small amounts add up to a lot of money in a 30-day period. So it's good just to know exactly what you're spending the money on, and then you can figure out where you might be able to scale back a little bit, and that money can go into savings, or maybe you're just not aware of how much you're spending. So it's a good kind of way to dive into exactly what you're spending. With debit cards nowadays, it's real easy to not really know exactly how much that adds up to in a 30-day period. When you're creating a budget, you want to make those goals specific. If you're saving for a home, that's a goal, that's a specific goal. Be prepared to compromise with yourself. Unfortunately, this process has to be realistic. You have to be honest with yourself, and you have to set it up in a way that is easy for you. If you're not flexible and you're not, you don't define it truthfully to yourself, it will never stick. You have to make sure if it's too stringent of a budget, a lot of times people will not stick to it. So set realistic goals and objections. You have to exercise a little bit of willpower. You may have to cut back on that morning latte every morning to save a little bit of money. Be flexible. As things go forward, you never know what's going to change, and certain circumstances you don't want it to derail your budget, but you can adapt that into your budget. Develop a good record keeping system. Figure out exactly how to get the information you need and make that easily accessible for you so you can kind of know that you're staying on track. We do have a monthly budget worksheet that is on our consumer pages as well that will help you put your budget on paper. It looks like this. It's an Excel spreadsheet, so when you plunk the numbers in based on certain things, it will tally it at the end and show you exactly what your total debts and expenses are, and then your income and the difference, and that will kind of give you an idea. Sometimes it's good to use a budget worksheet like this because some things you forget about, like how much you spend on medication each month, or certain, car maintenance. Sometimes we obviously don't pay for that on a monthly basis, but it's good to kind of figure it out on an annual basis and divide that by 12 so that you know kind of annually how much money you spend in a year on possible things like car maintenance. Know your credit score. We're going to dive pretty deep into this one because it's pretty important. Your credit score is an indication of the risk that your risk to a lender in whatever situation, whether you're applying for any type of loan, a credit card, a home, a car. The credit bureaus, there are 3, TransUnion, Equifax, and Experian, and they all have a little bit different scoring systems, but in the end, it's pretty much the same information they're gathering. Some creditors don't report to all three bureaus, so that may affect your score for the three different bureaus. But your credit score is basically the indication of how likely you are to file bankruptcy or default on a loan. The lower your credit score, the higher the risk you are. The higher your credit score, the lower risk you are. And your credit score plays a huge role in how affordable things are for you. So you want to make sure that you know exactly where your credit score is, what's impacting it, and maybe ways you can improve it. WHEDA's minimum credit score requirements for our loans, for the conventional loan, it's 620, and for FHA, it's 640. And we'll talk more about those loans in a bit. This is a very important screen because this really is what impacts your credit score and how it can affect you. Your credit score will impact the amount of down payment you're required to put down, the interest rate you will receive, the cost for your private mortgage insurance, the type of loan you may qualify for, as well as the cost of your homeowner's insurance, the cost of your auto insurance. All of those things are dictated by your credit score. So it's really important to know your credit score. And if it needs improvement, we'll talk about that in a minute too. But these are the things that impact your credit score the most. As you can see, the biggest is payment history. If you pay your accounts on time, that makes a big impact on your score. And sometimes if you have a account that reports late to the credit bureau, which means it's over 30 days late, that can impact your credit for a period of time. It sometimes takes a little while for it to get back up there after that 30-day late. So it's really important to pay your debts on time. The amount you owe and how much credit is available to you. This is a big one, and it's a big one right now for sure. If you have any credit card debt and you have or a credit available to you, a credit card, just let you in on a little secret. Anytime you owe more than 50% to the limit, it starts impacting your credit score negatively the higher you get to the limit. So if you have a $1,000 limit on your credit card and your balance is less than $500 reporting each month, that is actually okay. It's, it'd be great if you could pay it off every month, but that's not real life for a lot of people. But if you're paying just the minimum balance, that sometimes hurts you too. You're going to pay a lot over the end. But if you start to get over that $500 mark, and the closer you get to that 1,000, it starts to impact your credit score insignificantly. So make sure that you're watching those types of balances. Just for an example, someone that's starting to build credit might want to get a small credit card to start paying on it and paying it off and having that credit being reported to the credit bureaus to start building some credit. But remember, the impact is how much you owe on those. So make sure you're keeping that in check as well. Length of credit history plays also a fairly significant role. How long have you had credit? You may hear, if you're a fairly young buyer and you're just starting to build credit, you may hear someone refer to your credit as immature. They're not referring to you, they're referring to your credit. It just means that your credit doesn't have a long history of where they can see the history of payments for a long period of time. So it may, as you build longer with time, it's good to build that history of credit with one creditor. Sometimes people think it's a good idea to pay off all their credit card debt and close out their credit cards. Actually, sometimes that really hurts you for two reasons. You lose all that credit history you had, and you now have a debt, a credit that's no longer available to you. If it makes the most sense to your situation, you can do that. But just know, if it's a credit card you've had open for a long period of time and you close it and end it, you lose all that length of history. It won't be impacting your score anymore. Type of credit use. What is your mix of credit? So do you have student loans? Do you have credit cards? Do you have car loans? Things like that. They like to see a mix of credit, not just all credit card debt. That's a huge risk factor because it's all unsecured. If that helps. When you have a secured debt, like an auto loan, it's secured by something. just like your mortgage. It's secured by your home, your car. Those are secure debts. Unsecured debts are credit cards, things like that, that they're not tied to anything that they can take away from you if you default. So they are higher risk. And then new credit. How much is available to you that is new? I can't stress enough. Come Christmas time, as you're out there shopping and you go into every store and it says, hey, you can save 30% today if you open a credit card with our company. If you do that, it will actually impact your score significantly. You want to watch how many times your credit is being pulled. And you also want to watch how much new credit you're applying for in a short period of time. You want to kind of ease into that. So just so you're aware to kind of watch out for that. Credit repair needs. If you think that your credit needs some improvement, maybe it's, you pull your credit report and you can see, I've got some things on there I probably need to clean up a little bit to start getting headed in the right direction. There are a lot of community-based nonprofit groups that specialize in helping you work through that, improve your credit. They'll look at everything and tell you exactly what you need to do to help to improve your score. Things, there are certain things that you can tweak that will make a big difference or not a big difference. So they're the experts and they're there to help. There is also many online resources. There's a link right here called to the Federal Trade Commission, Fixing Your Credit Consumer Resource. It's got a lot of great information. If you can't get on this link, you can definitely just Google that and it will come out. Now, the only thing I want to add, just as an air of caution, credit counseling agencies are different than credit consolidation. Those online credit consolidation, usually they cost money and sometimes they can actually impact your credit negatively. So maybe a good place to start is someone local and someone you can trust that is a counselor, that they will walk you through how to fix that. The second step is finding a WHEDA lender. On our website, WHEDA.com, we have a WHEDA consumer pages. This is actually the link to that, and you can link to that. Otherwise, when you go on WHEDA.com, you're going to see a section that says home buyers and renters. And if you click on that, it will have a link called Getting Started. And that's the consumer pages. Within the consumer pages, there's a link called Find a WHEDA lender near you. This allows you to search by either the name of the lender or bank, the county in which it's located, or the city. So if you pull up your city, it will tell you all of the available approved WHEDA lenders within your area. So if you are interested in applying for a WHEDA loan, that's someone you could go to for that application. Now, just an air of caution, not all of our lenders offer all of our products. So you just want to make sure that if you're calling to ask some questions, that might be a question to ask, because some of our lenders will offer just conventional, some will offer conventional and FHA. The mortgage lending partners, and we'll talk about this in a little bit more detail, they're going to look at your monthly income, credit history, debt level, any savings or assets that you have, like retirement, and then they're going to qualify you for a WHEDA loan that's best fits your needs. They're going to actually qualify you for a loan, even if it's not WHEDA. They should give you some options based on your situation and allow you to look at those options to see what best fits your scenario. When you schedule that appointment with a lender, a lot of times in today's age, you're actually going to probably do an online application. And then they're going to look over that and get you scheduled to come in and start talking to them about your individual application. It's important to find somebody that you feel comfortable with and trust, because it's a lengthy process. There's a lot of hills and valleys when it comes to buying a home, just because there's some things that are out of your control. That they should be there to answer any questions and hold your hand kind of through the whole process. Some of us need a lot, we want to ask a ton of questions. Some of us, they'll just wait to hear. Depends on your situation and your personality, but you want to find somebody that mixes well with your personality and your preferred communication style. So here's just some questions that you might want to ask your prospective lenders. What's your process for pre-approval and closing? Make sure that the timelines line up with your home buying goals. What information will your lender need to pre-approve you for a home loan? We'll talk about that in a little bit. How do you communicate with your home buyers? Some people like to talk on the phone, some people don't. Some people want things sent to them by email or text message. So it's important to know, are they open to utilizing different forms of communication based on what your communication style is? What will my down payment requirement be? Will they require a down payment for you? Can you use down payment assistance based on your credit? What type of down payment assistance and grants do they offer or know that are available within the community that may benefit you as well? What fees will be included in my loan and due at closing? So obviously there are normal fees that are associated with a mortgage loan. There are some that can differ per lender, but you want to ask those questions, and you will be provided with some documentation and disclosures that are required by law for them to provide with some estimates at the beginning and then final at the end, which we'll talk about. Here's just some information on what to bring to that first meeting with your lender, because the more information you can bring to them, the easier this process will go, because then they're looking at they're looking at the facts. They have looked at your application and they've looked at your credit score, but that's all what you're telling them. Now you are going to bring the documentation to back that up. So bank statements, any other asset statements, retirement statements. If you own any other real estate, they may need to know that. Your residential history and address. So if you've been renting, sometimes you'll need the landlord name and address. They might need to have your rental payment information for the past 2 years. Employment income history, your pay stubs, W-2s, or most recent federal tax returns with all schedules. That's very important. If there's anything on that is new debt, like if you went out and just bought a car last week, that's obviously not going to be reporting to the credit bureau yet. So they're going to want to know if there's anything not on your credit report that's going to show up later, because I will tell you, they pull an initial credit report and they pull one right before closing. So sometimes if you do certain things throughout the process, it can really hinder your possibility of getting a home. So just know that they're going to tell you exactly what to do, what not to do, to make sure that that doesn't impact that within the process. And then obviously a copy of your identification. Here's kind of what to expect. You're going to determine what price range is affordable for your household. We may all want to live in a $300,000 house, but we may only be on a $150,000 budget. So they are going to look at the documentation you have to determine what is most affordable for you, what's going to be a comfortable payment for your situation. They're going to review the documentation you brought that we just talked about in the last slide. They're going to calculate your income and pull that initial credit report. And then they're going to ask for any further documentation. If there's gaps in employment or poor credit, you have a medical collection, can you just explain that? Because sometimes there are certain things that may need a letter of explanation that the underwriter may require. So they might need some more details about that. They'll determine if you may qualify for a mortgage and discuss your different loan options based on your down payment, income, credit, and property type. The two things I want you to know, two terms I want you to know, they're very similar, but they're very different in definition. A pre-qualification is not a firm commitment. This is not what you want to take to a realtor. This is, I'm calling up a lender and saying, I make this much money, I work here for this long, I have this much in my bank account. So based on that, what can you get me? And that person will take that information and give you a pre-qualification based on what you're telling them. They're not looking at the documentation or the facts to prove what you're saying. And that's what a pre-approval does. It's almost like a mini credit approval or decision based on a complete review of your income docs, assets, and credit report. And it obviously is based on other contingent factors like what the appraisal comes back in and what type of house property you're looking at. So the pre-approval is what you want when you start to begin looking at houses with realtors, because that is what a realtor is actually going to want to see to make sure that you're in a spot to look at whatever price range of houses that you may want or need. We talked a little bit about conventional and FHA. I mentioned that before. And in doing these webinars myself several times, a lot of questions I get are, what does conventional loan and FHA mean? What does that mean? A conventional loan is any mortgage loan that is not insured or guaranteed by the government. So this is generally the most common financing, and they follow Fannie Mae or Freddie Mac guidelines. So Fannie Mae and Freddie Mac are the big, you know, when everything went away in 2008, that was due to that. But Fannie and Freddie have come back, and they are the general purchasers of most mortgages. Any conventional loan, in the end, that loan is purchased by either Fannie Mae or Freddie Mac. So you're having to use the guidelines that they set out, along with any other guidelines that the lender may put on it, that allows that investor to purchase that loan in the end. An FHA loan is loans from private lenders that are regulated and insured by the Federal Housing Administration. So those that offer FHA loans usually have to have a direct endorsement with HUD, or the Housing and Urban Development, which is what FHA is under. And it's basically insured by the federal government. And it differs from conventional loans because they allow for lower credit scores and down payments as low as 3.5%. WHEDA actually has a down payment assistance program that would allow you to cover that 3.5%, so you wouldn't have to put that money down. But it's typically a government-backed loan that has a little more leeway with credit and debt-to-income ratio. There are other loan options like VA loans for veterans, rural housing loans like USDA. Those are sometimes limited to where you can purchase. Obviously, it would have to be a rural area. Your lender should discuss with you all the options available to you based on your qualifications. So step three, available mortgage programs. So here are the two mortgage programs that WHEDA offers. Our first mortgage program, WHEDA Advantage Conventional and WHEDA Advantage FHA. Both programs have different features and benefits along with different guidelines. Because we are the State Housing Finance Authority, our loan programs have additional benefits outside a normal conventional and FHA loan, such as reduced rates for qualified borrowers, which would be first-time homebuyers, veterans, and borrowers purchasing in a federally designated target area, and down payment assistance to allow qualified borrowers the option of 100% financing. So there are some regular Fannie Mae programs that may allow 3% or require 3% down. We, as the Housing Finance Authority, have what's called a waiver to allow for the borrower to utilize our down payment assistance and get up to 100% financing. Here's just a brief overview of WHEDA's first mortgage loan options. Obviously, we offer 100% financing to qualified borrowers. We offer 2 down payment assistance options, which we'll talk about briefly. Most property types do not require your own funds into the transaction. Sometimes you can get gifts or grants outside of the transaction, gifts from family members that you can utilize. We do loans on single family homes, 2 to 4 unit properties, condominiums, and double wide manufactured homes. Double wide manufactured homes do have to be on owned land. It can't be in a park setting that you lease the space. Like I said before, first-time homebuyers, eligible veterans, or borrowers purchasing in a federally designated target area sometimes may be eligible to receive a reduced interest rate with WHEDA. Our conventional loans offer reduced mortgage insurance if you qualify, and you will make your payments to WHEDA for the life of the loan. So even though we may sell your loan itself to Fannie Mae or FHA, we service all of our loans. So we retain the servicing rights. So you'll always make your payments to WHEDA. The one thing about WHEDA, as the Housing Finance Authority, obviously it's our mission to provide affordable housing. So part of that is we have to meet the needs of certain characteristics of our borrowers, like low to moderate income, which it could be range from a lot of, the definition is kind of a wide range, but our income limits are pretty expansive, but we do have total household compliance income limits. So when I mentioned before that we do have income and purchase price limits on our products, that is to qualify for your eligibility to do a WHEDA loan. So if you're a first-time homebuyer applying for first-time homebuyer financing, there are certain income limits that you have to be under in order to utilize that program. They're determined to determine the eligibility for a WHEDA program. It is annualized income and it's anticipated income from anyone 18 years or older who intends to live in the property regardless of their relationship to the borrower. So if you and one other person are on the loan, you're applying a joint application, but you have maybe a mother-in-law or father-in-law that live with you, if that person is earning any income, their income counts towards the total household compliance income. Our income limits vary by program, county, and household size. It's not the same as qualifying income. Qualifying income is what the lender will use to qualify you for the loan based on the applicants. So anybody on the loan, their qualifying income to make sure that you can repay that loan. Here, it just gives you a general way that we calculate it. It's gross income from all adult sources. So just know that if you go to apply for a WHEDA loan, this is something they're going to ask for. They're going to want to know who's all going to live in the house, their age, and any income they receive, because they will need to get documentation from all income sources in the household. What makes up a monthly mortgage payment? So your first mortgage payment, sometimes you'll hear it referred to as PITI. And what that means is principal, interest, taxes, and insurance. So when you have a mortgage payment, first you have the principal, the money you're repaying to the bank, the interest, what the bank charges you for the privilege of you using its money, so based off your interest rate, your real estate taxes, and your homeowner's insurance and mortgage insurance. So that's what I was talking about before, where it's broken down in 12 installments. It's 1/12 of your total payment, so that at the end, they can pay that when it's due. Here are our two down payment assistance options. We have the WHEDA Easy Close and the WHEDA Capital Access. The Easy Close can be up to 6% of the purchase price, but has a minimum loan amount of $1,000. Both of our DPAs have to be partnered with a WHEDA first mortgage. You can't do someone else's first mortgage and a WHEDA down payment assistance. Going back to the Easy Close, it is a true second mortgage that you make monthly payments on. So they base it off of the same interest rate that you're paying on your first mortgage. You don't get charged extra for that, but it's based off of a 10-year amortization as opposed to the 30 you will have on your first mortgage. So you'll have this will be paid off in 10 years. You can obviously pay extra and pay it off faster. That's completely fine. But so if you do a first mortgage and a down payment assistance loan with WHEDA, the Easy Close, you'll have two actual payments each month. They'll both be due on the first, and you can make those payments together. There is not separate income limits for the Easy Close. You would follow whatever the first mortgage is, what you're applying for in the first mortgage. And we actually allow you to use other financing behind our DPA to cover closing costs, as long as it meets certain qualifications. The Capital Access loan has a minimum loan amount of $3,050. Otherwise, it makes up 3% or 3.5% for FHA, the remainder of your loan to value to get you to 100% financing. This is actually a 30-year fixed rate mortgage, but it has 0% interest and you don't make payments on it every month. What happens is it just comes due when you sell the property. So you'll just pay the amount you borrowed back exactly, no interest accrues, back when you either sell your property or refinance out of your WHEDA first mortgage. The biggest thing with Capital Access is this does have separate income and total compliance income limits and purchase price limits, and they are significantly lower. So you want to make sure when you're talking to the lender that they're aware of that. They will know which to qualify you for. Step 4, homebuyer education. This is a webinar that we're going over today. This is just informational. It's kind of giving you a broad overview of the process. I know we're digging into a lot of information, but true homebuyer education that is required for all first-time homebuyers, no matter what program you're utilizing, can be done online or in person. There are specific standards that home buyer education needs to meet because it goes into great detail about other things like inspections and things like that. So your loan officer will tell you exactly what you're required to take and the options you have. And then just if you are purchasing a 2 to 4 unit, you are also required to take what's called landlord education. That also is offered online for free. Most of these are free. Sometimes they do come at a cost, but there are free options out there, both in person and online. And once you've completed homebuyer education, it is good. The certificate you receive is good for 12 months from the application date. Here's the fun part. So now you've met with the lender, gave him all your documentation. He or she has issued you a pre-approval. Now you want to take that pre-approval based on the amount they think that they're qualifying you up to and reach out to a qualified real estate professional. And I mean, you don't have to use a real estate agent, but they are doing it with your best interest in mind. If you go into a house that's for sale and that house for sale is typically listed by a selling agent, they're representing the seller. So if you go in and work with them, they are actually representing the seller, not you as the buyer. So they may not, I mean, obviously they hopefully do, but they may not have your best interest in mind because they're representing the seller. So it's sometimes important to have your own buyer's agent and and to work with their seller agent. But you want to make sure that you know exactly what you're pre-approved for and the price range so that you can tell that real estate agent, okay, here's what we're looking for. We want a ranch or a 2-story, this many bedrooms. What can you find within this area? And then they will start giving you, and you may find them on your own as well, options of homes to start looking at. It is important to be realistic with yourself about what is a need and what is a want. You need to distinguish between a need, which is how many bedrooms you may want or need, bathrooms you may want or need. Is it well maintained? Does it have a garage? How about the school district? Is it close to public transportation? Is it a short distance from work? Sometimes wants are more luxurious things like granite countertops, stainless steel appliances, marble in the foyer, or lots of land or an in-ground pool. Those are things that are more so wants. You want to be realistic with yourself about what is a want and what is a need. There is a home buyer checklist that we have on our consumer website that's kind of a guide for you to list all of your needs before you start looking at homes and to help you keep track of how each property you look at matches up with your list. Just briefly, I will touch on home style renovation. On our conventional loan, we have an enhancement called home style renovation. This would allow you as the buyer to purchase a home and finance any improvements or renovation you want in that mortgage you use to purchase the property. It's based off of the value of the house once the work is done. So you know that you're not walking into a situation where you're paying more than a house is worth. And you're still paying for the house what you normally would negotiate with the seller, but you may be able to finance all costs associated with your renovation, even 6 months of mortgage payments if you're unable to occupy the home while it's being renovated. But it has to obviously have the value. So you do have 6 months after closing to complete it, and WHEDA will, it does involve contractors and the title company and WHEDA handling your escrow account, but you cannot do any of the work yourself. So just in case you have that question, you cannot. But this is something that is available out there. It is not, our lenders have to become certified in this and take a test actually. So if you may want to ask if this is something that you're interested in finding out more information, ask that lender right away, do you offer this? Once you've found your home, the real estate agent will assist you in writing an offer to purchase. Again, unless you're working with a buyer's agent, the real estate agent is representing the seller, so keep that in mind. Once your offer is accepted, you will need to get the accepted offer to your lender because that's when the real process starts. Now all the rubber has hit the road, and now they're going to start ordering things like appraisals and title policies and all of that. You've got a house, and now we're starting the real home buying process. They will document any earnest money you put down, like that of a security deposit. It's basically like a security deposit. Earnest money is basically saying, I am willing to put $500 or $1,000 down right away to secure this property. That accepted offer, the offer to purchase, is a legal binding contract, and that earnest money usually will go towards the home financing once you close, but it is something that may be required. Making sure any inspections are completed. Within the offer to purchase, the seller is required to fill out a real estate condition report. So that they are by law having to disclose any defects that they're aware of. So you want to look at that too. But there is also something that is called an inspection. An inspection is very different from an appraisal. An inspection is someone that you hire on your own. It's not required by the lender, and I highly recommend it. It is money that you have to pay for out of pocket, but this inspector comes in and digs through that house with a fine-tooth comb to really look for any of those big ticket items like foundation issues, mold issues. They're going to crawl around in the attic. They're going to do things like that just to make sure that you know exactly what you're getting into. So it is, again, it's optional, but it's something I would highly recommend. Your lender will then provide you with the loan estimate based on the parameters of your purchase. So now they're going to start disclosing to you all the fees on the loan amount. So this is where they're going to get actual preliminary numbers to you based on the property you have chosen. And then they're going to order an appraisal to make sure the property is worth what you're paying for it. Once you've gotten through the loan process, I know that was one screen, and actually, if it could go that smoothly every time, that would be great. But hopefully you have a great lender that is walking you through and telling you what to expect throughout the process. But once that lender receives their clear to close from their underwriter, now we start to schedule the closing. Prior to your closing day, your lender will provide you with a final closing disclosure. They have to get that to you at least 3 business days prior to closing, and that details the final fees, the final numbers. That will tell you exactly how much you may or may not have to bring to closing. At closing, all parties will sign the papers officially transferring ownership of the property to you. A mortgage purchase or purchase transaction is what we call a table funded transaction. So the money changes hands right there at the table, not literally. It's usually done electronically, but they will literally hand you the keys at closing, and it's yours once everything is signed. You will sign 2 very important documents: the mortgage note. This details your promise to repay and the terms of that repayment. So your interest rate, the amortization, the monthly payment, and the loan amount. The mortgage or deed of trust is the document that secures the note and gives your lender a claim against the home if you fail to live up to the terms of the mortgage note. So what they would use for foreclosure, but it's basically deeding the property to you. And then finally, the best part, step 6, become a homeowner. With the closing done, you're now officially a homeowner. Purchasing a home with WHEDA Mortgage makes you part of your community, or any mortgage, where you have access to other WHEDA homeowner benefits. So there are some resources. These are links to things within our servicing department that you can access. We do allow you to make payments online, ACH, or over the phone, or you can pay by mail. We do actually send out coupon books still. At WHEDA, all of our mortgage loans are serviced locally. So just like I said, you will always make your payment to WHEDA. We will not sell your servicing to somebody else. You'll always make your payments to WHEDA until you either sell the property or refinance out of that mortgage. Here's links to helpful resources for you: homebuyer education providers, landlord education providers. The CFPB, the Consumer Financial Protection Bureau, has a home loan toolkit on their website. I highly recommend you check it out. It's got some really great resources on there on top of ours. Down payment resources. This kind of allows you to search based on area what down payment resources may be available to you. And then you want to double check with your lender that they participate in those programs. Obviously, the Find a WIDA lender tool, and then the National Council of State Housing Agencies Resource Center. So lots of great information for you. These are links, but you can Google any of these things or find them on our consumer pages. This is what the website looks like. You would just go to WIDA.com, click on the homeownership and renters, and then home buyers. And then that will get you to the consumer pages. At this point, we would ask any questions in a live training, but what I will do is ask that if you do have any questions following this, please feel free to email sales@wida.com, and myself or Mary or one of our crew will get back to you with the answers that you may have. Even if you're not utilizing a WIDA mortgage, we want to help you answer any questions that you have throughout the process. We wish you the best of luck. Thank you very much for joining us today, and good luck on your road to homeownership.